Hi there, I got a new investment idea from a viewer, and he's saying that this company, Barnes and Noble Education, is heavily shorted and undervalued with billions in revenue. And that's true. If you look at their past performance of that company, you can see that they made over 1 billion in revenue. And the market cap, as you can see, is only 16 million. So it's a huge difference. 16 million and over 1.5 billion revenue for the last year, 2023. Moreover, he's saying they have changed their business model and he thinks that could squeeze like GameStop. Could be worth 500 million and the market cap is under 25 million at that moment. And now is about 16 million. So based on this comment, I decided to do an analysis about this company and show you if this business is a good investment or not. As you can see, in the last few days, the stock price went up over 140%, almost 150%. And what's interesting is that the market cap is about $16 million and their total assets are over 1.150 million. So when you see this huge gap between the market cap and their assets, you might say that this is quite undervalued. You can also look at their cash position. They have 8 million in cash, half the market cap. And as you can see, merchandise inventories are worth 341 million. 341 million. This is huge compared to their market cap. And also the receivables, the money they have to get, are over 300 million. So this is quite a lot. Plus, they also have other inventories, textbook rental inventories, worth about 44 million. So when you look at this investment, this company, you might say that it's quite undervalued at the current level, and that's why the stock price went up so much, over 100% in just a few days. Now, what's the catch with this company? Well, let's look at their fundamentals first. You've seen that their total assets are over 1.1 billion. They have some cash plus a lot of inventories, merchandises. This might be good or bad. I'll explain you later why. Then let's look at their liabilities, total liabilities, which are about 1 billion. And as you can see, the short-term borrowings are over 200 million. 224 million. They took some debt in the short term and they have to pay it in the next 12 months. And the long-term debt, the long-term borrowings are about 30 million. So when you look at their assets again and compare what they have with their debt, the story is not that great. Because their inventories may be worth 341 million, but they are not able to sell them so easily. And if they have to do a fire sale, they have to sell those inventories at a discount, maybe 50% or even more, 60, 70%. So the real assets is not what you see on their balance sheet. What you can rely on is their cash. But be aware that this company is not profitable. As you can see, the total sales have increased in the last quarter compared to last year, from 448 million to 456 million. But if you look at their net loss, you can see that they reported a loss last quarter of about 9.6 million and last year over 25 million. And as you can see, this business is operating in the educational industry. They sell different products and they also rent other products and offer some services, educational services. And as you can see, the total cost of their products is quite high. They're able to make 450 million, but the cost of sales for product and other is over 342 million. And for rental cost, they have better margins. Their sales are about 41 million and the cost is around 23 million for the last quarter. But then you also have to add up their administrative expenses, plus depreciation, some impairment, and the most important, restructuring and other charges, which have increased in the last 9 months from 4 million to 12 million. And when you look at their operating income, you can see a loss. However, compared to the last year, quarter over quarter, their operating income has improved from a loss of 15 million to a profit of 900,000, and so their net loss from a loss of 25 million to a loss of 9 million. But the problem is, as I said, their debt, their huge debt that they took this quarter, over 224 million. As they are making no profits, because as you can see here, they have no profits, you have to ask the question how this company is going to pay this huge debt. Over 224 million. Because if you look at their past performance for Barnes and Noble Education, you can see that the revenue is over 1 billion for the last 5 years, quite 2 billion, but the net income is with minus for the last 5 years. Only in 2017, they succeeded to make 5 million in profits. And if this business wasn't able to make some profits in the past, how are they going to pay that huge debt over 224 million? Well, they can take on more debt because they have some assets, and maybe banks will lend them some money based on those assets. Plus, they'll continue to issue more shares. Because as you can see, for the last quarter, they started to issue more shares. The number of shares has increased from 52 million to over 53 million. And if you look at the past, you can see the number of shares. Here, shares outstanding for Barnes and Noble Education. You can see an increase from 40 million to over 53 million. And that's quite bad. You can also look at the stock price performance. You see this huge upside, over 100% in just a few days, because of a short squeeze. But you know what happened after a short squeeze. The stock price goes up, you see this bump, and then it goes down, as it already happened, a decline over 48% from its last peak. But if you look at the stock performance year to date, you can see a decline over 80%. And if you look at a longer period, let's say 5 years, the stock price has declined by over 90%. It was that upside during the pandemic in 2021 and 2022, because you know the story. People were at home, schools were closed, and as this company offers education services, there was a demand for their products and services. But as that pandemic passed, the stock price has declined back to 30 cents. And be aware that this company is traded on the New York Stock Exchange. And as the stock price is traded below $1 and the market cap is quite low, around 60 million, they might be delisted. So you also have to be aware of this risk, not only on their debt, huge debt over 224 million. This company might be delisted from the New York Stock Exchange. It may be traded on the OTC market. And if that happens, this business will have less liquidity. They won't be able to raise more money from investors to issue more shares or take on more debt. So you have to be aware of this risky investment. Don't look at a short squeeze or expect a short squeeze like GameStop, because as you can see, you might have this bump in the stock price, let's say in the last 5 days, as you can see here. You might have this bump of 150% or even more, but then the stock price will go down back to its normal level. Now, if you want to speculate, to bet that the stock price may have another short squeeze, then you can do it. But be aware that the risk of losing money is quite high, You can have another decline like this, over 80%, or to lose all your money. So, if you are a real investor and you don't like to lose money quite at all, then avoid this company. But if you want to play the game, to speculate, let's say maybe you might be right once or twice, then you can take advantage and bet for another bump in the stock price. Let's say maybe you'll have another increase over 700%. That will be amazing. And if you succeed, then please write me back in the comments and tell me you made a return over 700% in just a few days. Let's say like this, a return over 100% in just a few days. Or better said, in just one day. To have a return over 100% in one day, you are a great speculator. So that's it for this video. And if you have other questions about better investment ideas, then please let me know in the comments.